Welcome to TheoTrade. This is Don Kaufman. It's January 24th, 2025. Just about an hour to go to the cash close here on this Friday afternoon. The S&P futures down some 20 handles, but the week has largely been the Trump rally 2.0. You know, we're going to talk extensively about some of the price action to the upside, but I'd be remiss if I did not mention right up front the Trump rally. It hides a couple of red flags, and we are going to cover that and much more here, of course, on this TheoTrade weekend update. Let's just jump right into it. Now, I don't mean to kind of bear up on people, but there are some just blaring, again, red flags in this marketplace that some of you may or may not be aware of. And I'm going to kind of systematically work through them. Now, this is not necessarily to intimidate you out of a position or anything like that. But one of the things that you're going to learn here momentarily, okay, the marketplace and more active traders and portfolio managers, the bottom line, they're hedging, and they are hedging very, very heavily at this point. And I am intentionally kind of putting the cart before the horse here to tell you, again, the professional trading world evidently sees considerable risks. Now, that unto itself is not necessarily bearish. I want to make that really clear because it's not necessarily bearish. Just we see some heavy risks over here, okay? But when you start to look at some of those indicators, which we're going to, when you start to really compile, just more than it's not just looking at one indicator, another indicator, okay? There's a couple of really serious red flags in this marketplace, and I'm going to point those out right now. Again, the professional world is absolutely hedging. There's really only one reason that you hedge. That's, of course, obviously you see considerable risks in the near future. Let's get to work here again on this TheoTrade weekend update. As I said, the Trump rally hiding a couple of red flags. First, the bid back to the marketplace. I say it doesn't look right. And that's such a anecdotal thing, but the bid back to the marketplace, one of the reasons I say it doesn't look right, doesn't feel right, if you will, as the marketplace, and we're looking at the S&Ps right now, has got a bid back under it. No one's going to see this looking at the chart in the S&P futures, so just cancel that out right now. What bothers me when I say it's a bid back doesn't look right, okay? One of the things, if we look at the SPX, and I'm going to kind of zoom in for just a moment. One of the aspects I often will look at, okay, is, of course, expected move. We talk about expected move just incessantly here because that is the premier indicator that I use to really build, a huge number of the trades that I do. Okay, when we see, okay, multiple, okay, and continuous breaches of expected move, it's just a sign, if you will, of like an unruly kind of marketplace. So when you start getting breaches of expected move and kind of back-to-back weeks, you're going through this period where the market, okay, specifically the SPX, which again is called the mother of all products, but the marketplace is kind of getting ripped apart, and the market's not doing a good job of handicapping forward risk. So it's not when you just get one of them or two of them, okay? And they don't have to be exactly in consecutive weeks, but here you're seeing okay, so we, rip the expected move apart, things, calm down a little bit, rip the expected move apart this week, okay? Another breach of expected move. Now, we haven't closed yet. We could close inside this expected move, which I'm going to show you momentarily, but there's just no question that there's some, if you will, unruly trade going on. That to me starts off with a little bit of a red flag, because when you start seeing breaches, okay, and considerable number of breaches, and then moreover, consecutive breaches of expected move. If you're not calling into question, okay, some of the price action, it doesn't matter. Like when you're looking at expected move, no one cares whether we're breaching to the downside or the upside. Okay, these breaches, okay, basically say you're in a period of like, unruly volatility, and yet we're still seeing it. And it's one of the first things I say, it doesn't look right, okay, because you would expect it. Oh, volatility's calming down. Of course, everybody looks at VIX and they go, whoa, well, volatility is calming down. Really? How much is volatility calming down when the SPX, okay, is still what? You're 1, 2, and this is about to be 3 weeks of consecutive breaches of that expected move. How's that volatility calming down? In 3 consecutive weeks, you're telling me that the SPX has actually gotten it wrong. Nothing's calming down on that front. So that's one of the things that's, all right, it's just a little bit of a warning shot being fired, all right? The other aspect, though, okay, is that really this bond market, okay, it's by no means kind of waving the all clear. I mean, the bond market has actually been surprising, really surprising this week. And one of the reasons it's been surprising is it's been resilient even when Trump came out and actually said, well, we got to lower those interest rates. Yeah, do you see those interest rates getting lowered here in the ZB? No, you do not. Okay, they didn't even flinch. So when Trump actually mentioned something about AI, obviously Nvidia explodes to the upside. Okay, how easily an individual product is influenced. Trump mentions something about interest rates, not even a flinch, not a budge, not nothing. Better keep that in mind because I'm going to tell you right now, the bonds, okay, they're basically in a holding pattern. But if the bonds start to dip again, okay, it's just indicative, of course, higher interest rates, okay, and again, considerably more risk in the marketplace. And being the S&Ps, can the S&Ps really hold themselves together if we start to see higher rates again? Well, this is going to be front and center this week because clearly you have the FOMC and they're coming back to town. What's the FOMC going to do? We're going to talk about that here momentarily, but generally speaking, I'll just cut to the chase. It's absolutely nothing is what the Fed is going to do. Now, the bonds are in kind of a holding pattern. But before I go any further, one of the other things that really bothered me about this week is that the marketplace really has not, like, you look at this week against the SPX, and it's a holiday shortened week, right? So this is Tuesday, Wednesday, Thursday, Friday. Here we are. But during trading hours, there's after hours trade, and obviously there's a decent move this week, but during trading hours, there really wasn't much price action. Okay, the marketplace. All right, so you're going all the way down to a 1 day, 1 minute, and close that up for a second. I'm actually going to drop the time frame out. Okay, look at 4 days, and let's actually drop out to like a 10-minute in here and hit OK. All I want to show you here, okay, is in terms of price action for the week. Okay, we kind of trickled up a little bit on Tuesday. We opened a little strong on Tuesday. And by the way, there's no surprise over there. You have the inauguration on Monday, yada, yada, yada. Okay, we kind of trickled to the upside. Then we basically just gapped into the upper edge of the expected move. Now, from here to here is exactly $87.46. Okay, and when we gapped up to Tuesday morning, we literally gapped directly into the upper edge of the expected move. Did a little dance, made a little love on this Wednesday, got down tonight, ended on the expected move. Opened up on Thursday on the edge of the expected move. Thursday, right into the bell, boom. In the last 5-10 minutes of trade, we actually jumped 20 handles off of it. Here we are right now. What are we doing? Trickling right back down to where? The upper edge of the expected move. Okay, so price action this week has actually left me kind of wanting more. It's not, unequivocally, not been, if you will, fears to the upside. It's a bunch of crap. Right now, we're basically doing what we expected. Like if you look at this, the upper edge of the expected move is 60.85. What are we trading right now? 60.95. You're 10 points outside, okay, of where we talked about literally like last week. So again, nothing, if you will, unruly about that. The aspect, though, that just really resonates with me, we're still, again, kind of breaching these expected moves in consecutive weeks. It is very important as to where we actually close this market though today. All right, so let's move back that. So the bid back, again, I say anecdotally, it doesn't look right. Doesn't look right. Not just because I'm looking at like a chart over here. I'm looking at the S&Ps and, oh, it doesn't look right. So look, the SPX is getting unruly. The bonds are really not like moving much. The bonds basically still like, yeah, you know what? You can do what you want, S&Ps, but, we'll be here when things get serious. Okay. The next one, and this is a big one. When I'm saying, and I kick this off, okay, with like traders are still hedging, this one really bothers me. I don't give a crap about what somebody says about the VIX, because the VIX is a calculation off of 30-day forward volatility in the SPX. But I do absolutely care about VVIX. The VVIX is the volatility index. And the reason I care about it, the vol of VIX, VIX is, okay, there's no underlying, but the VIX options are, in fact, a tradable instrument. And if you are buying up, okay, calls in VIX, it raises the VVIX. Basically what I'm saying, if the demand for options is high in VIX itself, that's how the VVIX goes up. And if you demand options in the VIX, basically you're hedging. Hedging hasn't gone away. That's not up for debate. You don't get a 100, VVIX for nothing. I mean, if market, risk is down over there, there was a period of time like, after the election, like the election risk was here, and then the election risk really kind of died out. It picked up a little bit right before the election, kind of died out, but you would see VVIX back down like the 85 region if we were kind of waving the all clear. Clearly it's not, it's at 100. 100 is a well positioned for a very significant move in the marketplace. And again, that one's, there's things in this business that are up for debate. This one's not. There's hedging going on. To further that hedging, let's go look at skew. Skew. Now, for those of you that don't speak Total Geek, I say this every single week, but skew, it's the out of the money puts in the SPX versus the out of the money calls in the SPX. Okay, you go, oh yeah, that is geek stuff. Look, all it basically means is people are buying puts, and to finance those puts, they're selling calls. And the distortion, if you will, the skew, okay, skew is just that. It's like this distortion in the distribution curve. Okay, basically the implied volatility of those puts is going, up. Why does implied volatility go up? Because there's demand. There's no if, and, or, but about this. We're trading basically a 180 skew. And if you actually look, skew's only calculated at the end of the day. So if you look at skew, it's a print yesterday, literally at 180, and a print today at 179, and the highest print ever, it's basically 180. So we're matching the highest print of all time in there, which that doesn't necessarily, like, if you just looked at skew unto itself, that means squat. Like it doesn't, it's a really high skew. Okay, it just means people are hedging. But when you start to use that in confluence, okay, so now we've got skew, and I've done this before, and then things get unruly, right? So I've done this before, and I'm like, well, okay, you're looking at VVIX, and VVIX says basically like, oh, people are hedging in VIX, and now we're looking at skew, and like, evidently people are buying puts. Now, there's one of two reasons you buy puts. You buy puts as a hedge, or you buy puts because you think we're going down, okay? I'm actually under the assumption that trade is buying puts as a hedge. Okay, because you don't get an unruly skew like this just because, some monkey goes out there and goes, I want to buy puts. Like they're not just buying puts, and taking speculation on there. They're buying puts because they're nervous, right? That's it. VVIX points to the same thing. Okay, couple that with the bonds. Look, the bonds don't necessarily say that there's risk coming. They don't, all right? But I will tell you this, they sure as hell don't help where they're currently trading. Like 113 over here, that doesn't help because all we have to do is dip back down here to 111, which is, 2 points away inside the bond market. And all of a sudden everybody's like, holy crap, rates are going all time, like all time, like recent highs. I'd say recent highs, not all time highs, but I mean, you got to go back like, almost 2 decades to actually see interest rates as high as they are, right? And again, remember what I said about that. Trump actually mentioned lowering rates. Did rates get lower? No, they did not. And they're not going to listen. Okay. Why? Because, the bond vigilantes are still, I think, sitting on the sideline trying to contemplate, is this guy being Trump, is this administration, are they going to spend? Think about this. You start like lowering people's taxes, lower interest rates. Oh man, that's a nice recipe for inflation. Okay. And all of a sudden the bonds could start to sell off. Interesting scenario here. So bonds in a holding pattern, VVIX, skew is an all-time high. Market, okay, this one's my opinion. Markets are seeking a catalyst. They're literally just looking for the next catalyst over here. They didn't really get one this week. A lot of news breaking about executive orders and everything, okay? But frankly, did anything materially change in the markets? Okay, you can, of course, people, well, they did this executive order, that executive order, and we're going to, boom, the industrials went through the roof, and I got it, okay? But nothing materially changed, okay, to the underlying marketplace. Like, this is not making Google make more money, not yet anyway. And OpenAI, which isn't even a public company, is in a partnership out there, okay, is not, again, nothing, in my opinion, has materially changed. The marketplace, as I said, is kind of just seeking a real catalyst. And here's the irony. Next week, okay, catalysts we have. So if you look into next week, and I have to bring up the calendar. I hate to do this when I actually do like a weekend update, but I got to bring up the calendar because you start in Tuesday. All right, there's a consumer confidence number and some case Schiller that comes out, but things really start to get interesting because we're throwing in like durable goods. Okay. All right. So right off the bat, you got some durable goods, and people, I'm just telling you, I don't know which catalyst is going to spark some vol. Okay. But it's coming back. All right. That one, I assure you of, volatility is going to come back. We're going to get some wild and two-sided trade. Maybe this is the beginning where the S&Ps are now down 25. You got durable goods. You got consumer confidence. You got wholesale inventories. You have the FOMC. Listen, Jerome Powell, okay, probably not a close friend, if you will, of the Trump administration, although we will remind everybody that the Trump administration is who originally brought in and appointed none other than Jerome Powell. Jerome Powell does not go away for a while, so deal, right? Powell's not going to do anything with interest rates. That's not going to change, though, the fact that he's going to get up there and he's going to get into a press conference where he's probably going to turn around, okay, get his back up a little bit and say, there's no administration that is going to guide interest rate policy. That is our crew, okay? Look for it this week. There's actually going to be some crossfire, okay, I believe, between the Fed and the administration. But to be honest with you, okay, yeah, that's the opportunity for a catalyst. But there's a lot of economic data coming out, okay? And the economic data, you even got PCE data at the end of the week, which is actually the Fed's inflation indicator, okay, of choice. So there is a huge amount of data coming out. To compound that, few major earnings are coming out as well. So a marketplace that I'm telling you, okay, it has red flags in it, all right? S&Ps right now, they're coming home. We end up at like 60, 85. Well, at least we're inside the expected move, but that's stopping, again, some very violent moves. Again, how we measure volatility these days, it's not about VIX. Got to look at skew, got to look at VVIX, got to look at the number of breaches of expected move. All right, trading this week, okay? Well, as I said, trading this week, well, again, it hasn't been all that enthralling because so much time was spent. Upper edge of the expected move, upper edge of the expected move, upper edge of the expected move. Out of 3 out of 4 trading sessions, that's not exactly like, excitement and heart-pumping trade, at least for me. I did get some positions on, okay? One thing I do want to mention over here. So I took a shot on Tuesday. Again, it's a shortened holiday week. I took a shot on Tuesday at a put butterfly for today. Let me show you guys exactly where it is. So today, I have a put butterfly that is going to expire, okay, out of the money. Look at this put butterfly. It's all the way down here at 59.10. Okay, you're like, oh, you missed. I did. Okay, I absolutely did. But just want to point this out over here. So that was the put butterfly I did. And you can see I put these trades on, okay, January 21st, which obviously is Tuesday. However, this morning, okay, this is a trade that I did not text out. I will never text out an intraday trade. I should say never say never. I'm sure somebody will be like, oh, well, you got to text those things out. We opened this morning incredibly strong. I figured, there's an opportunity. Maybe we pull back to 60.85. So what did I do? Okay, I told you guys, I love trading butterflies around the expected move. So I put on a 60.85 butterfly this morning. Okay, you can see it right here, traded this morning. Paid 35 cents for it. I also just exited for $2.35. It's a winner chicken dinner. If you were there this morning, okay, you got into it, you got out of it. This is a nice trade. It's a really nice trade. So we are continuing this streak of hitting butterflies. And again, my apologies for those of you that were not tuned in. Tune in, turn on. I'm only on the first hour, okay, of trading sessions. Again, literally the first hour of a trading session during regular market hours. Last, but definitely not least, let's talk about the expected move for next week, because I do have a comment on this one. So this week, it's a holiday trading week. We have an expected move of $87, okay, and 46 cents. Then we come into next week. And next week, you're like, oh man, there's an FOMC meeting, there's big earnings coming out, and there's durable goods, and there's PCE data, and oh my. And then you look over here, okay, at the SPX, and you look at its expected move, and you think to yourself, what the? We only have, okay, an $84 expected move for next week. Okay, I'm left wanting more. Okay, I'm going to tell you right now, I'd be real careful. Don't sell any options this next week. Okay, if you're going to do anything with options this next week, you best be on the buy side. I'm serious about that. I'm still going to take a shot for an expected move, higher or lower. Okay, but I am going to say $84 expected move with a full 5-day trading week. Okay, whole lot of turmoil and possibility. The fact that, again, we've really got this great confluence of VVIX and skew and what I view as the marketplace just seeking a catalyst, okay? The Trump rally, as I said, this thing hides some serious red flags. Pay careful attention. Got lots of good trades coming in next week. Got some trades on today. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.